Welcome to the latest edition of The Bull, the Bear, and You as we take a look at what is happening in the economy and also in investing. I'm Stacy Smith, and I urge you to subscribe or say that you like this podcast on whatever platform you happen to be using. In this edition, we'll discuss whether there is a slowdown in the economy, and if there is, what effect that might have on the markets. So, you invested in money market funds when interest rates were going up. Well, now they're going down, so what should you do? Also, we'll talk about China, its economy, and its effect on the markets here, and perhaps how you invest. It's coming up on The Bull, the Bear, and You. With me to talk about the economy and investing is my panel of expert advisors, and they are Carrie Coghill of Coghill Investment Strategies based in Pittsburgh, also Frank Rossetti of HF Management Company, Kim Forrest of Boca Capital Partners, and Michael Godwin of Fergasso Advisors. Thanks again for joining us. And, at the beginning of this program, I always like to take a look at what's happened in the markets in the last couple of weeks since the last time we met. And in the last 2 weeks, all three of the major indices are up roughly 2% or more just in that 2-week period. And the Dow and the S&P 500 were sitting on new all-time closing highs at the close of business on Friday. And 42 weeks into this year, the Dow is up nearly 15%, the NASDAQ nearly 24%, or a little over 24, and the S&P 500 is up 23. Now, as always, as you know, there are arguments as to whether the bull market still has some legs. And among other things, some don't think it does because of equity valuations and record high prices for gold. On the flip side, though, some argue that earnings growth is solid and the consumer is still spending and the bulls have a lot more running room. So, Kim, I'll begin with you. Do you fall into either one of these categories, or do you have your own separate category?
I've just got to be different. What can I say? I think that, how do I put this? We're going through a slowdown now. In our little online green room, we were talking about an event that I went to over the weekend. And not only was demand for hotel rooms lower than I've ever seen, but also attendance. So, and it's a discretionary spending event. This is just all for fun that people go and do this, whatever the mystery event is that I'm talking about. But there were far fewer attendees. And to me, that says there's pressure on discretionary spending. And I think we've seen waves of this. If you look back in 2010 to 2019, we had waves where people were forecasting recessions, and then the economy would, snap back. But there would be a rolling recession through industries. Now, you're asking me specifically about the market, and I'm talking about the economy. Why is that? Well, the market reflects the expectation of the economy 6 months ahead. So I think looking at what we've heard so far from earnings season, which we're going to be in the thick of it this week, but looking at what we've heard so far, I think we're having a rolling slowdown started sometime this summer, but the market expects things to pick up. So people are buying individual companies, not the market, where they think that they're going to go up in the next year. That's how people generally think, I believe, in this market. So that's what I think. I think we're having a slowdown, and the market's going to creep on higher.
Anybody else have any opinions on this?
Creep on higher is an interesting phrase. People have been used to these 10 and 20 and 30% returns, which are abnormal, just like they were used to zero interest rates, which are abnormal. Carrie says time and time again, we're trending towards normal. Normal in the market is what, 10% maybe? And with a correction most years, I don't think we've had one this year, maybe last year either. And that being said, the market's going to be volatile. We've got an election that is particularly violent, if I may say, and we've got the result of that election, which is probably going to be more violent because it will be unresolved, in my opinion, for quite some time. That hurricane didn't help. We have all these side events going on, like hurricanes and natural disasters and wars, and that are affecting the economy, and sometimes not always positively. So slowdown is probably reasonable expectation. I'm not sure it's all bad.
Yeah, I would say that, how Kim was describing this is very true. It's, we're seeing it and we're not seeing it. I happened to be at the mall yesterday. Lots of parking spaces. Steelers were not playing at the time I was there. And, but yet, as I do everywhere I go, as I'm upgrading my iPhone, which I dread doing, and today I know why, because my phone's a mess, but that's another story. Um, but I ask, like, how's it going? Are people upgrading? And what I was told is that, yes, in fact, they're, really sold out of a lot of the 16s, but people are still even upgrading to the 15s and even the 14s. So this upgrade cycle looks good. So I take note of that. Um, just in terms of various companies that may be related. I do also give a lesson in, are you participating in your stock purchase plan? But that's only my, kind of community work, I'll say. So I think that you just have to be aware and have to be careful. And like Kim was saying, I think that people are more concerned right now about buying individual companies than buying the market as a whole. The one thing that I'll just clarify is I do think these market returns are very normal. And yes, when we look at average returns over time, we know kind of where we should be on average. But this kind of volatility that we see with the market up as much as it has been, it's normal. Just go back and look at it. Doesn't come 8% a year or 10% a year. The key is to know that you're banking some gains so that when the market is down 10, 15%, you're still going to be ahead of the game.
All right, I'll take the opposite side of Kim. I think the economy is still chugging along very well. Um, Wage growth still is pretty high. Unemployment is ticked down. It's not. It is a little bit harder to find a job than it was a couple of years ago. That's natural in an economic cycle. Um, you heard the old adage that the economy is not the stock market. And yes, I do agree with Kim that a lot of the times they are intertwined. But we look at the S&P 500, that's only 500 companies within the U.S. when the majority of the U.S. economy is comprised of small and medium-sized businesses, which don't make up the stock market. But that being said, they are somewhat intertwined, I think. I do believe that longer term returns in the equity markets are going to have to come down. Carrie's absolutely right. You have many years where the returns are well above the historical average of 10% per year. In fact, you very rarely see the average historical return actually come to fruition of 10% per year. It's either well above or sometimes it can be well below that. But valuations in the US are pretty stretched, which leads me to believe that the longer term average going forward, next 5 to 10 years, are going to be significantly lower than what we've seen over the past couple of years. Even though the economy, I think, Kim, remains relatively resilient over the next couple of years.
So I have a question for anybody that wants to take it, and that is, maybe I'll go back to Kim on this. And you say you think there is a slowdown that's happening within the economy. So if there is a slowdown, will the Fed take a look at this, or is it some other data points that they will be taking a look at to decide whether they're going to lower interest rates anymore?
I think the Fed hews to, well, this Fed, because every Fed is different, right? The participants are different, and the Fed head is different. But the Powell Fed seems to be purely driven by their two mandates and then data. So they need data to support every activity that they take. They're always going to be late because that's what the Fed does. They look for data. Data is always backwards looking. But I believe full employment and stable prices are their concerns. And they're looking at the employment data, which is weird, right now. We've gotten some weird surprises. And I think they're questioning the data collection and data grooming part of it, which I can feel people's eyes glazing over right now, not just the participants here, but yes, you over there on the other side of the camera. But here, there's been issues for the past maybe like 6 or 7 years where the revisions have been greater at the end of the year than people wanted. So the jobs data that the Fed uses isn't all that clean. So, but I still think that that's the data. And they do like listen to businesses and people, but the data drives them, not commentary.
To,
All right,
Kim,
so
to Kim's point there, Stacy,
go
sorry,
ahead.
the Fed cares about two things: inflation and essentially jobs. I think this Fed cares much more about the unemployment rate and growth than they do inflation. So, to your question, if there is an economic slowdown, that generally means that you'll see the unemployment rate go up. They're pretty much synonymous. So, in that event, I do think the Fed will get a little bit more aggressive in cutting rates to try to stimulate the economy, more so than worrying about if that's really going to impact inflation.
But it will be lagging, correct? Because if there's a slowdown, it takes a little while for people to start losing their jobs, and then it takes the time for the Fed to realize, oh, people are losing their jobs, right?
Generally, yes.
Yeah, generally. Okay. The second question about this, and then we'll move on to something else, is if there is a slowdown taking place, and you're an investor, I know we're looking at longer term holdings here, but if you're an investor, do you start to really critically take a look at consumer oriented stocks?
I'm going to jump in here and say they're probably going to be, especially consumer discretionary and consumer staples, they're going to get bumped up by people's fear and greed, motives in buying stocks. It seems whenever there's a slowdown, people really want to buy those consumer staples because they feel it's a safe place to put money. That's questionable because how fast did you get in and what multiple are you paying and what price are you paying for that stock? But and consumer discretionary tends to get punished in a slowdown, as it should, because it's discretionary and those companies are going to get less revenue. So, but I think, you have to watch and just have good companies and a diverse portfolio as opposed to trying to prevent harm, which you think is the absolute value of your portfolio going down.
One thing that Kim, I think you said the Fed is always for backward looking. The reason they're backward looking is because their goal is to be right. It's easy to be right when you're looking backwards. It's almost impossible to be right a lot when you're looking forward, which is what we are being asked to do right now. And the forward looking thinking is very difficult to measure and often wrong. And that being said, it's why most advisors believe in using an allocation, spreading the money around different ways so that the whatever happens will be treated well somewhere in your portfolio. And that will over time level out your performance and make it be what you need. Maybe not market beating, but what you need.
All right. Well, I'll throw this in and just say that you're probably absolutely right, Frank, about not really being able to analyze correctly, looking toward the future, except for the four of you. With that, I'd like to change the.
You keep score and tell us how often we were right.
Okay, I don't know if I want to do that or not. So I'd like to change the conversation just for a second here. And the Fed meets again in November. That's, of course, 2 days after the election, by the way. And the question is, will they lower interest rates again? That's what we've been talking about here. And a lot of speculation, as we know, but what we do know now is that with the recent rate cuts, that money market rates have been falling. So, Carrie, if you're invested in money market funds, what should you do?
Well, this is the trap. And I'm sure that we talked about this when rates were going up and how attractive money market rates were. And, we have clients that were like, well, if I can get over 5% in a money market, why wouldn't I do that? And now we're seeing why you wouldn't do that, because there comes a time where we start to see rates falling, and that is in direct response to a Fed that is on a lowering track. So we have seen rates come down oh, a quarter of a point or so. If the Fed lowers again, we'll probably continue to see that go down. And the problem is this: if you were to go back and look at when money market rates were at their highest and where the market was, and say, okay, I'm going to put $100,000 into money markets or $100,000 in the market, you would have been better off by putting it in the market. That because the market returns have blown away the 5.25% you could have been getting in money markets. Now the challenge is your money market rates are falling, the market's at an all-time high. So the classic mistake, right? Get out of your money markets and put it into this thing that's going gangbusters. Well, as we have just discussed, that's tricky because no one wants to buy at a market high. We don't know if this is the market high. It may be the market high for this cycle. You really have to look. It is now time for those people that stash money in money markets to be very methodical about how they get their money invested, which they should. The problem is that, this kind of analysis leads to paralysis, and people tend to stay in money markets and really miss the boat. So as we're having this conversation, even about consumer discretionaries, consumer staples, where you make your money is in a trade that doesn't feel good. So if we see consumer discretionaries come down, guess what? That's the time, this whole buy low, sell high thing. We also want to be looking for kind of those cyclical transitions. I guess about 8 weeks ago, we had a real opportunity to go in and grab some technology names, and that didn't last very long. But you have to be an active manager if you're really wanting to take advantage of the dynamics in the market.
I heard said once, Carrie, to emphasize your statement there, if you're comfortable with the investment you're making, don't make it. If you're uncomfortable, it's probably the right time. And if you're really uncomfortable, it's even probably more so the right time, providing, of course, it's a quality investment to begin with.
Right.
So let me back up here just a second, Carrie. And you're talking about the money market. We're talking about funds as such, and that's why you're going to lose what maybe. Well, I don't know if you're going to lose much, but it's not going to be as fruitful for you because the fund that they're paying is well. Help me with this one, would you?
Yeah, it's the interest rates you're getting. So your return on your money is safe. That's why it's so attractive, because your money's safe, but yet you were getting 5.25%. Why would you put that at risk? Well, now you're not. Now you're getting 4.7. And if the Fed lowers rates, you're going to be getting less. So you're not losing money, but your upside potential is dramatically going down. I literally know people that are still in cash from the 2008 crash. That's how hard it is to take money that's in a guaranteed investment and put it into something that has some risk. This is where we earn our living, because we're really analyzing various sectors. And a lot of times, as Frank was saying, it comes down to owning good investments and your time frame. Now is not the time. If you're going to need this money to send your children to college next year, now's not the time to put that money in the market. Mm-hmm. So you really have to pay attention to what your overall goals and objectives are to know that you can ride through any kind of market volatility. But then the other layer that I think we all add is, because we're so close to understanding how sectors perform and what we think may be overvalued versus not. We've had in the last, and this is more Kim's lane, so I don't want to steal her thunder, but we've started to get reports out, earnings reports, and just even looking at the financials, little all over the place. But what we're looking for are those financials that have some sort of growth tied to them. So yes, maybe they're trading at an all-time high. Maybe technically they're overvalued, but we see that growth driver. So we can deal with the volatility because we want to earn it long-term versus something that's very traditional. They haven't made acquisitions. We really don't see those growth drivers. So, this is where we really earn our keep.
what we're really talking about here is managing risk. And while some people, they look at the money markets whenever we were in a rising rate environment, they go, not only can I get return, but I can get safety. And I'm going to tell you, those are, I mean, you might for a little while, but as Carrie so ably points out, you're still embracing risk because you don't know that the rates are going to continue to go higher, and it's probably a problem, like the economy or inflation isn't good, that your money or that the inflation or sorry, that the money market rates go higher. Now, why is that a problem? At the very basis of all investing is the concept of pricing power parity. Gosh, I love a good alliteration. But pricing power parity for those people in 2008 has disappeared. It has evaporated if they have been sitting on their cash, afraid to put it to work. And now that dollar is worth a whole lot less. And that's the risk we're trying to take off by putting your money in vehicles that might go up and down more than you might be comfortable with. But we're trying to protect your ability to spend at the same rate that you have in the past.
So, two questions for you, and the first one is: should you never go into money market funds then?
I don't want to take that one because I'm an equity girl.
Okay. I think you definitely.
I'm going to punt on that.
There are definite times to go into money markets. If you have an expense that you think is going to come to fruition within the next, call it, year or so, and you need to park your money in a very safe, reliable vehicle because you're going to draw on that. You're buying a house, you're buying, as Carrie mentioned out, you're going to pay for your first year of college. That is absolutely fine. But in regards to the money markets, what Carrie brought up, they paid 5% last year. Sounds great. Clients love to hear that because they paid nothing for 8 years before that. But most people fail to realize that inflation is at 3.5%. You're netting 1.5%, and then you get to pay taxes on that. So your net return, your real return, as kind of Kim was pointing out, is less than 1% on a money market fund. So I think they're very, very good vehicles if you need to draw on that capital, that money within a predetermined time frame. But as an investment, as an asset allocation strategy, there are much, much better ways to put much better areas to put your money.
So that's the second question. Oh, did you have something to add? I'm sorry. Carrie,
Go ahead, Stacy.
All right, so my second question is this, and there is a differentiation then between money market funds and owning or investing in bonds. Am I correct? I mean, if you invest in bonds, you are basically guaranteed that return for the bond that you bought. Am I correct? No?
Depends on the bond.
Yeah.
Yeah.
To kind of maybe simplify this a bit, money markets, they don't have any fluctuation of price.
Okay.
When you buy a bond, as Kim said, depending upon what bond you buy, basically all bonds except CDs, they can fluctuate in price. So as long as you hold it to maturity, you're fine. But if you needed to sell it, you are subject to market fluctuation. One thing I'll kind of add.
But you are guaranteed that interest rate if you hold it, right?
You are, to the full faith and credit of whoever promised you that interest, yes.
Yes, okay.
Which I don't know that we trust anyone, even the government at this point. But I want to go back to something we were talking about with asset allocation and money market funds, because there actually are circumstances where we use money markets. We have to remember that we're dealing with people, and people have risk tolerances. People have biases. So, if I have a client walk in the door and they say to me, look, I don't like bonds. People do that. They don't understand them, but they don't like them anyway. But we know we can't have all their money in the market. We will use what's called a barbell approach, where we will actually buy stocks in money market and come up with an allocation that we know that money market will kind of cushion the blows that we get, the volatility of the market. So sometimes we will, because that's what the client's comfort level is. The other time that we will actually use money markets is in a time where we think that bond prices are going to be going down. So if we are in a rate hike cycle, we know that bonds are potentially going to struggle. Timing the bond market, it's just as tough as timing the stock market, but we get a little more runway on what we kind of can foresee is coming. Right now, given that we are in a interest rate decline cycle, we like bonds. So sometimes we will toggle back and forth between using money markets and bonds. Generally, as a rule of thumb, it's not really an investment to us. It's a risk management tool.
And let's clarify something here. A money market is a collection of very short-term bonds, less than 9 months, that somebody is pinky swearing that you'll get your buck back, okay? It's too much to tell you about like the pinky swear part, but they're not FDIC insured, but you will get your money back. Just as a definition here, what a money market is.
Okay, that's good.
Well, you should get your, like, when compliance looks at this, which they do for us, you should get, we can never say you will, but you should. I mean, it's not happened in the past where you didn't. There were some rocky times in '08 where there was a question about money
Right.
markets kind of breaking that dollar, but the forces, I always say when the forces that make the rules can change them, you can't bet against that, which is what happened.
Right.
Yeah, I think they actually, if they're not government bond funds, I think they actually, I don't think they have broken the buck, but I think they can, because they have to mark these things to market. But as Kim says, they rarely change in price. So we're not talking about 10%. We're talking about a penny here, a penny there. Wait a week, it'll probably go away. but if you need the money today, that penny might matter.
Okay. Let's change subject once again, and let's talk about China for a moment. Its economy is not meeting expectations. It has a major problem with housing market in China. Its local governments are running up huge amounts of debt, and consumer spending in China is not as robust as they would like to see. And you add to that many U.S. companies are in the process of pulling out of China. So, how important is China and its effects on your portfolio and perhaps on this economy here? Thank you for your response.
I want to give other
take it?
people time. I have thoughts, but somebody
Okay.
else start.
All right, let me start it with the economy in China is not growing as fast as we've become accustomed to see it, but they announced, not that you can believe what they announced, but they announced that their economy grew 4.6% last year, which is about twice the rate our economy is growing. And yes, they're having a problem. It's because they've borrowed incredible amounts of money to create the infrastructure that they built that has yet to be used. They have built a bus to handle a lot of business that hasn't developed. Add to that their intrusion into corporate events, and our companies have decided they don't want to tolerate that. They don't have to be there, and they're pulling out. And I quite frankly can't blame them. So something has to give. I have no idea what it'll be or when it'll be, but something has to give over there. You're right, Stacy.
Yeah, the world is interconnected. China's a big country, as we all know. So any slowdown there is going to have a ripple effect. It may not be as direct as maybe it would have been years ago, but it's going to have more of a direct effect on Europe, which then has a trickle down effect on us. I do think from an investment perspective, a lot of people are diversified into international funds and, really looking at the implications of a China slowdown on what you might own overseas is really important. But it most definitely, it's still a very interconnected world.
Go ahead, Kim.
I don't think China is our friend. I think China has many, many problems, probably two of which that I'll talk about is one, they are a shrinking giant. The one-child policy has really worked. And if you do the math, in one generation, you should have half the population. Not a good idea. So maybe in 2 generations, but it's shrinking. They've built all these apartments where people have put their money and no one's living in them. I'm not sure who's going to buy them if the population continues to shrink. And they have they're just kind of a mess. I'm going to throw out a book recommendation for Dennis Unkovic. He's a Pittsburgh attorney who has written a lovely book that that was just out this year. It's called The Fragility of China. And he's a frequent commenter on CNBC. And he lays out all of the problems and some of the positives of the Chinese economy in really understandable, short kind of chapter. It's a great book. It's an easy read for people that don't know anything about China. And it's fascinating. Again, Fragility of China, and you can make your own mind up on whether or not China is investable or not. I say no. No, it's not.
Okay.
Directly investable.
They haven't really been that investable for quite some time either. I mean, they were the economic engine of the world for almost 20 years. But if you look at their stock market performance over that past 20 years, they've drastically underperformed not only the U.S., but even their other emerging market counterparts. So I do think they have a lot of problems going forward. Kim mentioned the one-child policy, so their demographics are not good to begin with. Many of their biggest businesses are what's called SOEs or state-owned enterprises, also not the most business-friendly, certainly from a stock market standpoint. So Carrie's point is very valid. I mean, since they're so big, they are interconnected from a global standpoint. But from an investable standpoint, we own China, but in a very, very underweight fashion compared to their representation in a global benchmark.
One final question, and then we'll end our program here, and that has to do with tariffs on China. I mean, I'm not talking about what may come, but there already are tariffs on China, and if there are more, perhaps on either candidate is elected as president and whoever runs Congress, will that have an impact on China itself, or more of an impact on the U.S.?
I mean, it impacts both sides. Tariffs are inflationary. We know that. We can go back to the beginning of global trade. You know, there was a great article in the Wall Street Journal. I think it was the Wall Street Journal. Somewhere I read in, the early 1900s when this whole idea of, protectionism against Central America and what that did for perpetuating inflation. So for as good as it sounds, and I'll be honest, I don't understand the depths of exactly where they're putting these tariffs, and there's a lot of kind of economic philosophy around the whys. But if the U.S. isn't,
also a lot of political philosophy around
a
this.
lot of political philosophies about let's do this segment. We're gonna put tariffs here and not there. Right. But anything like that would cause Americans to not buy Chinese products, that would impact. But then we're in a capitalist society, so if prices on Chinese goods go up, then are American companies going to raise prices on their own? Kim probably knows that more than I do.
I agree with everything Carrie has said. Tariffs are difficult to understand from an economic perspective. Probably the thing I do agree with is the volume of basic materials that come out of China, including steel and aluminum. And the fact, as Michael has pointed out, the state owns those companies, so they don't actually have to make money. They just have to employ people, which is one of China's problems. They always have to be employed. And the state does that at money-losing mechanisms. But I think that's where the world kind of has handed China a gift through tariffs or taken money away from them, is they were just setting prices too low. in commodities, the price of the last thing bought sets the price for the good. And China was able to, because its mills don't actually have to make money, just make tons and tons of steel, literally, and aluminum, and then ship them all over the world, which has depressed the world, market for those values. So in that case, I think tariffs have been, or should have been, the beginning of a discussion with China, but China's uninterested in having the discussion on steel and aluminum.
Okay.
Let me add, Stacy, before we close. You could take this whole conversation, roll it back 40 years, and we'd be saying Japan.
Yes.
Good point.
And Japan was taking over the world, and a funny thing happened. Their economy hasn't grown since they borrowed too much money to support their industry so they could sell cheap goods around the world, which is exactly what China's doing. And there is an end to that game. Your guess is as good as mine as to when that is, but it may be closer than we think.
Good. Great point. All right. Thank you again for joining us. We will continue to look at investing in the economy in our future editions. Also, once again, I urge you that if you're watching or listening to this on whatever platform it might be, please hit the subscribe or the like button. And for right now, that does it. So thanks for joining us. So we'll see you again for the next edition of The Bull, the Bear, and You. Thanks.